Non-deductible loss exclusions for disposition of assets. Loss exclusions refer to specific types of losses that are not allowed. So we see a lot of ways that we can have deferred tax strategies, and those are good things, whereas loss exclusions, these are bad things. This is the IRS saying, you can't do this. These are not allowed to be deducted for tax purposes. These exclusions are in place to prevent taxpayers from taking advantage of the tax system. Who would want to do that? Not me, for sure. Here, we're going to discuss three types of these: wash sale losses, related party transactions, and personal losses, and we'll have examples of each. Related party transactions, we got a whole lesson on that, but we'll touch on that as well here. Everything in this exam kind of overlaps for sure. Wash sale, I'd say, is probably the biggest, most important point here, and one of the types that people get confused with the most, so we'll go through that best we can. Wash sale, what's the purpose of this? This is to prevent, I would say the iconic example, this is to prevent someone from selling their stock at year end to get a fat loss, buy it back, let's say 2 days into the new year, because generally the individuals have a calendar year tax year. So if I want to sell a bunch of stock that's at a loss, and just for that year, I want a big fat loss to deduct against other gains I have, and then I buy it back, 5 days later, that's what this is to prevent. It's also similar to short-term and long-term capital gains and losses. It's to help create liquidity and stability in the market so that people are keeping their investments in the market longer rather than just, kind of day trading. That's what the point of this is. For example, let's say you purchased 100 shares of XYZ stock at $50 per share, which gives you $5,000 in total. You later sold those shares for $40 per share, which is $4,000 in total, which results in a $1,000 loss. Sucks for you, unfortunate, you have a loss there. However, you repurchased 100 shares of XYZ stock for $42 per share within 30 days of the sale. All right, so that is trigger warning, red flag. We see that ding, ding, ding. We are thinking wash sale rules. This constitutes a wash sale, and as such, the $1,000 loss you originally had cannot be deducted because you went and bought this back. Now, even though I did give the example of this is commonly used at year end and you're selling things, let's say on December 30th and then rebuying them on January 6th or whatever it may be, this still applies any time of the year. That's just when it, commonly would be used for lots of people. But this is a wash sale. The $1,000 cannot be deducted. Instead, this is a deferred loss. The basis of the new shares is adjusted to $5,200, the original purchase price plus the disallowed loss of $1,000, and the date of acquisition remains the original purchase date. So again, how did we get that? This is the new basis, and all we do is we take the original loss you could not take and you add it to the new basis. And let's say it asked for the new basis per share, you would say $4,200 plus $1,000 divided by 100 shares. So you see how the basis per share increased. Remember, a higher basis, that is going to result in less tax paid once you sell eventually. You will see sins where you buy, sell, and you got to keep track of the basis. And then eventually you can have some of this loss eventually lost forever. We'll see examples of that in our multiple choice questions. It's a lot more rare, but in general, this is a solid example of wash sales. All right, got another example here. We're going back and forth, buy, sell. And we got to keep in mind the difference between our dates. We've got some that may be a month apart, some that might be less than a month apart. Obviously, that's the key here. On January 1st, you buy 100 shares of XYZ stock at $50 per share. This is going to be $5,000 in total. We're going to use a lot of the same information from the prior, and we're going to kind of continue the example. On February 1st, you sell all 100 shares at a loss. So here is where we saw ourselves in the prior question. We've got a $100 loss here. Sorry, $1,000 loss here. Then on February 15th, you repurchase the 100 shares for $42 per share, resulting in a $4,200 amount. We're going to now add the $1,000 to that amount. Well, we'll see how that all works. And then on April 1st, you sell all 100 shares at $45 per share, $4,500 in total, resulting in a $700 loss. This is obviously 30 days after February 15th. We got February, March, April. So here, this is like a clean sell. This doesn't get caught up by wash sales. Now, to determine the allowable loss deduction for wash sales, we need to consider each transaction, and these are going to be the sale dates. That's obviously the most important here. When was it sold rather than repurchased? Because the sale date is when you would normally recognize the loss. So the first sale on February 1st is a wash sale because when you repurchase the stock within 30 days of the sale on February 15th, the $1,000 loss is disallowed. Instead, the basis of the newly purchased shares will be adjusted to $5,200, the original purchase price of $5,000, plus the disallowed loss of $1,000. So that's kind of catching up to what we saw prior on our slide before, but never hurts to get extra practice on this process. Then the second sale is not considered a wash sale because we did not repurchase the stock within 30 days. That's well after 30 days, before or after the sale. However, we need to calculate the loss based on the adjusted basis because our basis went up. Basis went up to $5,200 based on the disallowed loss. Sounds good. So we're going to take that minus the sale proceeds, and that gives us $700 eventually of a loss. Thus, the allowable loss deduction is $700. So this overall has no net effect so long as at the end of the day you have a sale that's not within 30 days. So there's no net effect overall. Now, maybe year to year there's an effect because you decided to do this as a multi-year transaction. We're going to use that $700 to offset any capital gains, or in the case of no capital gains, deduct up to $3,000. We're seeing that amount again. It always strikes back. $3,000 against your ordinary income with any remaining losses carried forward to future tax years. A wonderful example here. Just make sure you're getting practice in for items such as these. You could see these definitely on the exam. And again, like I did say, sometimes the questions will ask for the loss per share. That obviously is a nice little distractor. So if you see something like that, divide it by the amount of shares, and that's what you get. All right. Next up, related party transactions. Losses from the sale or exchange of property between related parties are not deductible, unfortunately. Related parties include family members, such as spouse, siblings, ancestors, or lineal descendants, and entities in which the taxpayer has more than a 50% ownership interest. Here, for an example, you sell a piece of property to your brother for $80,000, and your original cost basis in the property was $100,000. Even though you've incurred a $20,000 loss in the sale, this loss is not deductible because the transaction took place between related parties. So it was a disposition, and in this case, you cannot take that loss. Again, we do have a whole lesson on this, but just looping it in because this is technically a disposition. Here, personal losses incurred on the sale or exchange of personal use property are not deductible. Quite unfortunate, right? If you sell a car, that's usually going to be at a loss because cars are depreciable assets. They don't really ever increase in value. These losses are personal in nature and not related to income-producing activities. So, for example, this is just you personally. This has nothing to do with business. You just go out and you purchase a car for personal use at a cost of $25,000. After several years, you sell the car for $15,000, resulting in a $10,000 loss. If, as far as you've experienced in your life, this has never been tax deductible, so you're not going to be able to do it here. Kind of just a reminder of what you've experienced in real life. Unfortunately, you're not getting a benefit from that loss. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.